Hello everyone, let's do a technical analysis on Keppel DC REIT. But remember, there's no hocus pocus. I think technical analysis is a quite useful tool if used properly, but sometimes people overuse the TA and turn it into some kind of a witchcraft trying to predict the futures and stuff. I don't think it's very correct. But I think TA, if used correctly, gives us a very good feel of the sentiments of the market and of the various market participants versus just fundamental analysis, which just shows you the economics. So let's do a deep dive, and this is a typical picture of what a chart would look like from a 1 year perspective, and this is from Yahoo, right? So using a simple line chart, you see it's not a lot of information, right? You can see that it's kind of on the downtrend, but I think more information can be gleaned from the usage of candlesticks. So if you click on this button here and you choose candlesticks, this is what you get. And I think over here you see much better information, right? The first thing that I'll do is just do some simple trend lines. So if you connect the highs of the various periods, you get something like this. So you can see this the line joining the highs, right? And remember, you should always use 3 points or more, 3 points or 4 points or more, because a line connecting 2 points is just meaningless, right? Meaningless, right? Because any 2 points is a line, so it's completely meaningless. So a line should always have 3 or 4 points or more. So it is high, and this is the low. You can see that it's quite clear, right? It's increasing volatility. If you do up the trend lines, and of course this is because of the interest rate hikes and the inflation concerns in the US, right? That pretty much stemmed in late December last year and accelerated into January and so on and so forth. You can see inflation, in fact, really kicking in, right? So if you think about it and you just take the effects from January this year, from when the inflation in the US hit almost 8%, you draw a line since then, you can see that the lines are more well behaved, right? You can see the channels of equal width. So the volatility has kind of normalized a bit post the initial shock over here. And over here you can see a bit of a consolidation pattern as the markets reassess the impact of the inflation and the rate hike prospects. And this is the 1 year perspective again. And you can see that the another way to look at it is from trend lines on a horizontal perspective, right? So instead of looking at things diagonally, it's quite useful to look at things horizontally. And over here you can draw some lines again, strong tops and bottoms. And you can see that actually quite well behaved for this guy. And these are the lines, right? And you can see that each channel corresponds to a certain phenomenon, right? Which is the US Treasury in the 10-year, right? So over here, it corresponds to a 10-year Treasury of 1.25. Over here, 155. Over here is 225, and over here is around 3%. So you can see that the movement of the Keppel DC REIT unit prices is pretty much strongly correlated with the 10-year Treasuries, and it's almost pretty much in lockstep movements, right? So the correlation has been remarkable, which is not true for all REITs. So I think one conclusion you want to draw from this is that this REIT is almost pretty much a bond proxy for some market participants. You can see the movements in lockstep, and for each period over here you can read the treasury curve yield, and you can see it corresponds pretty much exactly. So it's a very rate sensitive instrument. It's the first conclusion. And over here, if you look at the expectation of DPU, it's around 9.8 cents, right? If you divide it by the share price of around 2.5 over here, you get a 4% dividend yield. And over here is around 10 cents. So 10 cents divided by around $2, you get around 5% dividend yield. So that's kind of the movement of the REIT, right? It has moved from a 4 percentage point yielding instrument to 5 percentage point yielding instrument. And you might ask, why is it that the movement is not linear? So the treasuries move from 125 to 3, right? So that's 1.75%. But the yield compression expansion, I mean, just 1% instead of 1.75. But it's not really the right way to look at it, because the markets are always forward looking, right? So the yield is more of like a 1 year forward DPU expectation divided by the 1 year forward 10-year treasury expectation. Whether it's 1 year or 9 months or 6 months is debatable, but nonetheless, it's always going to be forward-looking. So if you look at it from NET's perspective, this 4% yield is actually something like a 9.8 cents dividend yield annualized currently at that point of time, plus XX of DPU growth, and you divide it by 2.5% and not the 1.25, because at this point the expectation for the 10-year treasury looking forward is something like 2.5%. So that gives you a 4% yield, right? So a 4% yield versus a 2.5% for expectation, or a yield pickup of 1.5%. So over here, a 5% yield is actually more of like a 10 cent plus X over 3.5%. Because over here, although the 10-year treasury is at 3, but the forward expectation is more than 3.5, right? So you can see the 5% is against a 3.5% for expectation, or again a 1.5% pickup. So actually, if you look at it, right, it's very, very surprisingly constant. So a 4% pickup, sorry, a 4% yield over a 2.5% for expectation, or 1.5% pickup, and the 1.5% pickup applies over here as well. So 5% yield over a 3.5% for expectation. So that's really remarkable, right? Because if you look at the CAPM formula, so R equals to risk-free plus market beta times the risk premium. So it's almost exactly the same, right? Because when the risk-free move from 2.5 to 3.5, the yield move from 4 to 5. So 1% and 1%, right? So it's almost as if the market premium did not move at all for Keppel DC REIT. So I don't think there's a blowout in the credit spreads in this individual name. This is just a market beta moving in accordance, which is a good thing to see, right? Because what can happen is that for some REITs, if the markets suspect that the credit profile would weaken and there's increased risk for the individual name, you might see that the yield explodes out to what 8% or 9%, right? So like increased market premium needed for that name as funding cost rises. But I think for this name, it's still regarded as kind of a steady blue chip name with a strong credit profile. So that's quite nice to see, I think. Next we look at the CMF, the Chaikin money flow. It's quite a nice index, I think. So you can look at it on a 1 year perspective again. You can see at the in late last year, there was monies moving out of this REIT, but that really accelerated in January this year, right? You can see that the CMF really hitting a peak over here, and the area is pretty decently big as well, right? And this is what you expect, right? Because when the rate hike fears accelerated, then funds moved out of REIT and all interest-bearing instruments. But over here you can see an even bigger movement out, right? And the CMF actually hit a low of around 0.6, which is pretty significant for a decently sized REIT. So if you look at the results from a 6-month perspective, focusing on this gap over here, right? This is actually occurring in mid of April, end April, when the results were released. So the results were released on the 19th of April. So you can see upon the results of the release of the results, there was a big volume and a big gap down in the share price, and this is a big red bar, right? Indicating that there was a big gap down, a sell-off, accompanied by strong volumes. So I guess a bunch of guys were quite disappointed with the results. And over here, it was because of the DPU being flat year on year. Actually, the results were kind of okay, right? It wasn't a big fall. So I guess the markets were expecting like a strong growth from the DPU on a year-on-year perspective. And they explained it, right, because of provisions made for a client payment under dispute, and of course higher electricity costs stemming from the high utility prices. And the sell-off here was quite strong, right? And that was the contributing factor for the CMF outflow. And you can see that the post gap down, the sell-off continued over here, and kind of abated over here on stabilized around here. So you can see the presence of around a lot of doji candlesticks, right? So a lot of indecisions and not sure what to do. Quite interestingly though, subsequently over here you have quite a strong and healthy green bar of a pile up. And this volume over here is also quite sizable. So I think the presence of this guy over here suggests that there's a bit of a support at a 5.2% dividend yield level. So that corresponds to a price of around 1.9, right? So you can see that on the price chart perspective, there's a decent support around the 1.9 to $2 area, right? I don't think it's surprising that this coincides with a 5 percentage point dividend yield level for the REIT. Because I think for a blue chip name like this guy, and you can see from the previous analysis that the market premium did not really rise for this fella. So people still treat this guy as a blue chip, steady dividend payer. And I think at current levels, current stage, people think 5 percentage point is sufficient and enough compensation against the fears of rising interest rates. So that's on the downside, right? I think the 1.9 to 2 level seems quite a decent support. And on the upside, I think this gap here has to be watched because there's a saying, right, that you need to fill a gap before the trend can be reversed. So whether or not you can fill the gap around 2.2 level is important to watch. So around 10% upside from here, right? So if this gap can be decently filled, then the upside can be resumed with maybe this guy is coming back in again. So that's it for this video. If you like what you saw, remember to subscribe and like.